is the Treasury Management Quarterly Monitoring Report.
Yeah, thanks Chair. This is the first quarterly monitoring report for the financial year 23-24. Members will recall that this process starts really at February full council, when council approves the Treasury strategy for the forthcoming year, and what these quarterly reports do, they update you really on the Treasury position and whether we're on course really to deliver that strategy. There's a lot of information in this report. What we'll try and do is pull out the key sort of strategic highlights to bring to your attention, and I'm happy to take questions on the whole of the report. I always begin these presentations, if you go to the table at N2.5, that really gives a summary of the Council's Treasury and non-Treasury investment position at the 31st of July 2023, comparing it to the closing position last year. But as you can see, it's probably the first time for a while we've reported this, there has been a slight reduction in debt during the period. It's fell by nearly £12 million. That's largely because due to some of the loans that have been repaid in the period. Our investment deposits have gone down in the period, and there's been a sort of a slight increase in our non-Treasury investment position. That's as we pump more money, more units into Virtual Park, really to capital expenditure on the park to take the park forward. If we can move on, perhaps if we can talk about section 2 now on investment. So I think as part of the strategy this year that we have delivered on, we've been trying to really de-risk the portfolio. That's largely because interest rates are rising and we can get really good returns now on overnight money. So a larger proportion of our funds has been going into overnight deposits, and also one of the things we've done in the period, we're withdrawing all our funds from the Alternate Wealth Bond account. That's for a number of reasons, to reduce our exposure to bonds, but we've also got a very successful managed account with Altana, so we are actually going to use that as the main vehicle. It's going to probably take 6 months to exit that position, because what we don't want to do is sell all our bonds at a loss. So as the bonds mature, we're actually running that fund down. Another key one, obviously, we've got quite a big exposure to property. I think when we reported in the outturn report that compared to what we paid for the investments, we were still up, but there were some impairments on them last year. So I'm pleased to say that in the first quarter, really, the property markets, or the type of assets that we got has really stabilised, and there's actually been no movement there. If we can move on now to talk about our borrowing position, which is given in section 4, and to follow on from Councillor Critchley's point, yeah, we are in a very, very fortunate position, and we're probably unique amongst local authorities in that when interest rates were low, we tended to borrow long, so we've got some considerable premiums with the PWLB. At the end of the period, we've got £265 million worth of premiums. What that means, if we were to, in effect, pay the PWLB back, they would give us 265 million really as a windfall. If I give you an example of this, we've got probably the best loan on the book of 100 million. If we were to say pay that back tomorrow, we would give the PWLB 100 million, and they would really give us £50 million back. In a nutshell, that would be the bonus, but that's because we did borrow long term. You're probably hearing a lot of councils that are issuing 114 notices, and one of the reasons is that they've borrowed huge amounts of money short term. So they borrowed the money 18 months ago, and when interest rates were 1-2%, thinking those days were ever, and now they've got to borrow at 6%, and they're borrowing hundreds of millions, and they can't sustain that. So that is one of the reasons. Thankfully, Warrington doesn't have that problem. If I can take you to what table is it? Yeah, the maturity structural borrowing, I think, includes that table 4.5. We do have some borrowing, roughly £160 million worth that we do have to do this financial year because we've got a load of loans maturing. Again, whether we borrow or whether we don't will be dependent on whether we sell any assets. But the most of that borrowing will be in Q4 next year when everything starts to mature. And there is some borrowing next year, I think off the top of my head, of about 50 million. But we do have the repayments of the Salboy loan next year. So the two really match themselves up. So unlike a lot of councils, we don't have a large degree of refinancing risk. I think when we do borrow, one of the things you'll find that we will do, and I imagine most councils are doing, instead of borrowing long term that we've done in the past, we will borrow short term. The reason to borrow short term, all the forecasts are showing that in the future, probably in 18 months, 2 years time, interest rates will come down. So it's pointless us locking into 25, 50-year money when rates are going to come down. So you'll find that there is sort of a switching policy there. I'm pleased to say that we've operated within all the prudential indicators that were actually agreed by council at the February meeting, and section 7 gives you an economic update. That this is not something we've written, it's what we get from our Treasury advisors link, which is really based on probably a medium position of what all the economists are saying. I won't go through that because you've only got to turn on the news or go into social media with what's happening in the economy, and I'm sure a lot of you are more highly versed in it than we are. I think that it also covers, there was a meeting of the Treasury Advisory Panel in the period, and we've covered some of the agenda items, the main agenda items that were actually discussed there. And what's not covered in it, if we just do an advertisement, Chair, we do have Treasury Management training for members arranged for. We've got a really good section arranged for you on the 26th, and we are trying to make that applicable to Warrington, so it's being given by our Treasury Advisors link, and they've got all the data. So in the past, whereby you probably had a generic presentation, this will really be a presentation that will roll in on the issues MRP with regard to the Warrington scenario. So if you are available that day, I would urge you to attend. And as I say, it is quite an extensive report, Chair. Hopefully I've not missed any of the key highlights, but I'm happy to take any questions that you've got.
Just clarify, Danny, is that the 26th of this month?
Yeah, it's the 26th of September, isn't it?
I think I booked on it, I'm just not looking down to hand.
Yeah. Tuesday, yeah.
Better get my diary.
Okay, thank you.
You should have had the invite, as I say. If anyone's not had an invite, sort of please let us know.
I'm blaming the legacy of the anaesthetic at the moment.
Okay, do we have any questions? Anybody else?
Yeah, quite a few, and some are comments, but I would say quite a few questions. All should be relatively quickly answered. On page 71, Danny, I am just struggling with the valuation of Birchwood Business Park, given the comments of the Deputy Leader in answer to my question. Because the answer I had to my question was putting the valuation much more towards 200 million, not the 250 million rounded that I had referred to. So that figure in these numbers is £244,256,000. So I don't understand the answer that the Deputy Leader gave me on Monday. So can you just check which, if these numbers are correct, are the Deputy Leader's numbers correct?
I think you'd probably have to take that up with the Deputy Leader, but I mean, Danny wasn't even there to have heard that. I'm not exactly sure. I didn't take a verbatim note of exactly what she said to you either in response.
Yeah, fortunately I have a recording, so I'll refer to that. But it seemed as though she had either misunderstood the numbers or had been given numbers that were not correct. I'll just make one point about risk and return. Table at 210, again, page 71. My main issue is that we do not know the risk of these investments and we do not know the return. And that, as I said on Monday, for me, makes this report incomplete and to some extent misleading. So that is the big challenge I've had for over 2 years now, to try and allow members to have an understanding of the relative risk and the return. I think it's also better, I'll just make a comment, also better rather than saying housing company, if we could call it incrementum, so it just makes it a bit clearer. And obviously there were some really strong returns from the solar farm, so I wouldn't shy away, but it would help us sort of evaluate whether these investments are good in financial terms or not. So I know I can pencil in a 1% net return against Birchwood Business Park, and we'll all draw our own conclusions about that. If you turn to page 72, I'll just make a comment. I do have concerns about tying Treasury cash up long term. So the Altana fund was invested in, irrespective of the return. I do have a fundamental concern about tying cash up long term in it that is Treasury cash. So the Altana fund started on the 28th of the 1st, 20, and is not due, I guess, to be wound down on the 28th of the 1st, 25. It'd be good to also understand the return since inception, although I think we're putting that on the work programme, and Altana update should be on the Altana update. The Altana short-term investments are presumably money market. We've got some sort of investment in a quoted fund. And again, I think I made the point last time, it'd be good to amend the table so we can see what is the value of that original cost, what is the value of the quoted fund, any additions and any income that we have taken or sales we've made. Because again, it's very hard to understand really what is going on here without that sort of information. If I think to the basic Halifax ISA information that I get, it will tell me what my original cost is and further funds I put in, I've taken any funds out, and what my current value is. So, I'd like to request via the chair that we look at, making these tables a bit more meaningful rather than just a list of numbers. Page 73, I just want to know, is Abundance for Liverpool, is that loan at risk? It's at the bottom of the bullet points.
Yeah, I think in terms of presentation, we will take some of your comments on board, and really we'll try and do a bit of a revised structure for when we report the half-yearly review, which does actually go to council. I think some of this is an education piece as well. I think we put out Tana on the work programme. I think the best way to learn about these funds if someone comes and gives you a 30-minute talk, because we do get we do get oceans of monitoring material from the city and everything. I think in terms of Abundance, it's a bit difficult to what I can say at the moment with it being a public meeting, but we are in negotiations at the moment. I suppose I can't sit here and categorically say that we won't actually lose anything on the investment. The bond has actually defaulted. There's various options on the table at the moment that we're working through. There's obviously other parties involved, so there is actually a risk there that the authority could actually take a hit on that investment. If that occurred, we would just charge it to the Treasury Management Risk Reserve. But there are there is an asset base there still in abundance, and that's what we're working through at the moment to see how we can actually restructure the bond to maximise the return to the council.
And presumably, though, they have breached the covenants?
Yeah. I would say everything's been breached, yeah.
Okay, because there's a statement later on to say there have been no breaches of council of covenants or any of the loans.
The investment with Abundance was not a loan into Treasury management, so it was a bond. The covenants refer to our loan portfolio. That was just the Treasury bond investment that's really gone wrong.
Okay, just touching on those covenants. Is that the case is that correct in the case of Auxesia, or were the covenants waived by the council?
And I don't think any covenants have been waived by the council. I think in terms of Auxesia, I think we've reported this on a number of occasions, and we do. And a lot of the detail on this in terms of loans and everything, we do report into Cabinet on a quarterly basis. So there is a very, very detailed there is a very detailed report that goes to Cabinet. I'm not aware that there have been any breaches of covenants with Auxesia. All the issues with Auxesia have actually been solved, and they were solved very, very quickly. Auxesia being a new housing association, obviously the bar that the regulator sets is very, very high, so they got an adverse judgment around about Christmas time last year that we were aware of before it was actually published. Auxesia put an action plan in place straight away. One of the criticisms was of the financial leadership of the company. What they've now done, they've appointed a new finance director that's been in place now for the best part of a year, who is the former group finance director of Your Housing, so she's got vast experience. They took on a new head of finance who's got housing experience. So all the reports that are going into the board now actually tick all the boxes. They've also appointed a number of non-executive directors who have got housing experience. So the regulator is now satisfied that Auxesia is on the right path, and we are. We've got a presentation. They're actually coming in to see us, aren't they, in about 2 weeks' time.
Yeah, it would be good to have an update, if you can share an update on Auxesia, because obviously it does raise a question mark in my mind about the due diligence that led to the investment in that business, when by Christmas last year it was determined that they had failed on some pretty basic financial metrics, and rather hurriedly had to put a finance director in place. I'd be worried putting a 20 million loan into a company that didn't have a finance director. So it'd be useful to have an update just to know the current position.
Yeah, no, I can give you all assurance that a comprehensive due diligence process was carried out. I think the regulator did actually say it's not uncommon for new housing associations to fall foul of the regulation, because the regulations on housing are just so strict. So that primarily is why we invest into the sector, because to a large degree it is low risk and it's very, very highly regulated.
Thanks, Danny. Let's start turning to table. The table on page 74. There's a reference to original drawdown. Now, is that the facility available to the entity, or is that the drawdown of the facility? I don't think it's particularly clear as to what the total exposure is under the facility.
Sorry, my machine
page 74.
Yeah, sorry, apologies, my machine had crashed, so
yeah.
I've just got it back up, yeah.
So I think there should be on there a column that shows the facility available to each of those entities, and I'm not sure that table does that.
But I probably share with you, it can be a bit confusing. I think in the left-hand column is the facility that was agreed, so that's the facility.
Okay, if we could say that, because
Yeah,
the original
yeah.
drawdown implies to me
Yeah.
the first tranche that was drawn down from the facility.
Yeah.
But then, I know that all facilities haven't been drawn down, and I'd like to be able to understand which facilities are not drawn down. So if that's the case, it'd be great just to change that to facility available. And then I just want to touch on, there's a number of facilities there. Facilities agreed: tourist housing, £98 million, places for people, £100 million, and £30 million for Irwell Valley housing. Can you just explain those? What are they? Are they new facilities, old facilities? Nothing's drawn down against them. Is that right?
You're entirely correct. They're facilities that we've negotiated with tourist places for people in Irwell Valley, and primarily nothing has been drawn down to date. The one, funny, I contacted tourists today because the tourist one actually expires in April next year, whether they want to consider renewing that. So there are facilities in place, but the housing associations have not drawn them down to date.
So possibly in that table then it'd be good to see those facilities under the facility column, and then the balance at zero, so it's just easy to see within the table. On the table on page 75, I note that New Bailey's only increased by 1 million, and that seems low. I understood that the New Bailey investment was over 100 million. Not sure what's going on there.
No, I think in terms of New Bailey, it's just the drawdown period of the borrowing. I think there's one, the bulk of the repayment actually takes place on completion. So I think there's about another 50 million or so to go out the door in the coming months.
Yeah. Sorry, Danny, that's the value of the investment property on table 3.5. So what I was looking at is I was expecting New Bailey to be increasing quite significantly, because at the back of my mind it's over 100 million of potential investment. I think it's something like 150 million. Yeah. And I don't understand why in a 6-month period it's only increased by 1 million.
I think what the column's saying is that it's the money that's gone out the door. So in the period, there's only £1 million being paid over. I think the payments are back-ended. So when the deal, on practical completion, which I think is coming up shortly, there's going to be another transfer of about £50 million. So I think when we report the half-year position, and that figure will be probably in I think New Bailey off the top of my head is £111 million scheme. But the 990k is the payment that was made from the council to the developer during the period. Okay,
so that's proceeding as planned.
That's proceeding. Yeah.
Great. Page 76. I'll see if this is still relevant. 313. I know you direct us to the report of the administrator, which is quite a lengthy document. It'd be really helpful, certainly to me, maybe to this, to the Audit and Corporate Governance Committee, if there was an officer report that sort of summarised what was going on in terms of Together Energy, the Together Energy Administrator. Also, I've certainly picked up that there are some difficulties with debt collection. And I think that may be referred to in the report, so it would be really good to know what is happening. If there are difficulties with debt collection, we can then at least have an opinion about how, to what extent we are exposed. But I'm just recommending to the chair of the committee that we have an officer report. It doesn't need to be super detailed, but rather than we have to plough through an administrator's report would be really, really useful. You won't be surprised to know on page 77, I'm still struggling with Redwood Bank being described as having another good year. We'll probably have to agree to differ. If I'd lost 25 million, or impaired down by 25 million in terms of an investment, I would not be describing it as a good year. I might be describing it as improving, because certainly the underlying profitability is improving, but I do struggle with that. And then we have wire regeneration, page 77. What's the status with the old bus depot? I was thinking about governance. I'm thinking about governance of the old bus depot. Has that been transferred to the council? Is it now with the council? And how is it going to be tendered?
Yes.
Okay, I'm going to try my best because I wasn't prepared for the question. My understanding is that whatever happens with that, the station is going to be demolished, it's going to be cleared, it's got to be decontaminated in order for it to be built on. And my understanding after that is that then it's going to be a question of what the council actually does with it. My understanding was that it was in council ownership. If it wasn't, then I think it was due to be, and I think that was part of the deal to sort out the new bus depot, that we get the old land. Then it's a question of how that's marketed and who's going to take that on. Now, my view obviously would be that it is property, it's within our ownership, and Section 123 will apply, which means that we have to get best value for that, and it has to be subject to an appropriate valuation, and therefore the appropriate funds should be obtained for it. So it's not the best answer I could give, Councillor Critchley, but it's the best I can on the basis of what I can remember at the moment. Clearly I would be expecting it to be coming back before the appropriate decision-making body to deal with that, given its potential value. Thanks.
Okay. Thank you, Matt. Just page 77 again. Incrementum housing. Now, this is described as a sort of commercial venture. But again, I have a slight alarm bell ringing, because given that green homes are built at a premium to standard homes, how will that impact the return? Because presumably you don't have an increased rental income. Although the homes cost more to build, you'll be subject to the rental income on more standard constructed homes, or homes that do not have a ground source heat pump or whatever other such system. I think we had an answer to one of the questions from full council, which said that the cost of the homes is something like £14,000 higher than the cost of a standard home.
Yeah, I'll try and answer that. I think what we tried to do with the initial scheme and have been successful, you can obviously build passive houses that cost an absolute fortune. I think Norwich have done a great scheme, about 30 houses, but it costs some ridiculous amounts of money. And what we're trying to do with Incrementum, and what we've done with the ones that we've built today, is build them to a high climate change standard, but to keep it within a cost envelope. What we've managed to do with Incrementum to date is attract a lot of grant funding, so a lot of the ground source heat pumps and batteries and everything that we put on the first two schemes, we did actually get a number of grants for, and some quite large grants as well, to actually keep the costs down. But it equally as well, if we put all this kit in, it does increase the value of these properties as well, and it's playing a major role. You've obviously got to do cost benefit analysis as well, the relief of fuel poverty. So when we started to build these houses a few years ago, when they were at the planning stage and we were putting all this kit in, I think it was due to generate savings of about £400 per property. I think last year, with what we had the situation with energy prices going through the roof, it was about £2,000 per property, and the feedback we've had through, some of the people that are living there on low incomes, that's a phenomenal amount of money. So I think you've actually got to balance the two. But we have been very successful to date in attracting grant funding, and on the new schemes as well, we are looking at new modular technology whereby, you can build houses off-site that can potentially come in cheaper than the brick version, and there are higher ESG standards.
Thanks, Danny.
Certain councillors.
Sorry.
I think Danny sort of answered one of my points in terms of it's not just about what return the council will get in terms of income, but it's about what effect it will have on our residents as well. And the savings from the solar panels, from the ground source heat pumps, although, I mean, you can quantify it by like what savings they'll get, but it goes beyond that as well in terms of security for their own person and sort of addressing those basic needs. I think that might be harder to quantify.
We do have a climate change strategy as well and an action plan. So I think we can't say that we're going to reduce our carbon, and by the way, we're not going to build future houses. I do understand that there is a cost envelope, but I think we've got to do all we can to build future houses to high climate change standards.
Just got a couple more. Good. Just turning to Zebra, page 78, 3.22. It says the Zebra project is to electrify the bus fleet is progressing well, but the increase in borrowing costs could increase the cost for the project. Now, does that mean that borrowings are going to increase, or that the long-term cost of the project is going to increase? I'm not quite sure what that's saying. I read it as potentially the 30 million of council borrowing would have to increase because costs are increasing, but I've maybe read something slightly different. Could you just explain that sentence?
Yeah, but what the sentence was saying, obviously when we agreed Zebra a year ago, interest rates were much lower, quite considerably lower. I think when we did the initial business case, I think interest rates might have been about 3.5%. Interest rates are now at 5.5%. So obviously the buses have been ordered and the buses will be arriving sometime next year. It's staggered, but we've got to pay for them. So compared to the original business case, we're probably borrowing at the moment about 2% extra. So there's an increased cost to the council of that scheme.
I'd understood from, I think, something in the budget that the cost per annum of that scheme to the council, the increase in the council cost base, was something like £3 million per annum with interest and MRP.
Is that the overall cost? Yeah.
The cost, the £30 million of borrowing, the additional 30 million the council has to make. In terms of the scheme, there was an on cost, I'm guessing with MRP, but interest of some £3 million to the cost base.
Yeah.
I seem to remember going through that.
Yeah.
Has that increased further then, given current interest rates?
It would have increased further. Yeah, we reported to Cabinet in the capital monitoring report that went last week that interest rates have obviously gone up. So I think the capital programme this year alone has gone up another £450,000 in terms of borrowing costs. That will include probably a very large part of that will be for the Zebra scheme.
Okay, thanks, Danny. And then just turning to page 82, 4.8. It's the reference to the 265 million premium. And you may have started to answer this, Danny, when you said there's one loan for 100 million that if repaid would provide a 50 million of that premium. But just so I can start to understand the scale of repayments, what value of loans would need to be repaid to release the total amount of the premium?
Well, I think in terms of our loans, what at the moment, I'd say if we repaid all the loans, we probably get a third of the premium back. You know, if you actually split it, we probably, what is the total figure we've got in loans at the moment? About 600 million something drawn down. We've got about 750 million in property and about 100 million in solar farms, and the remainder is the capital programme.
So, sorry, again, probably not being clear. we've got the premium that we could generate by
Yeah.
repaying certain loans, PWLB loans.
Yeah.
What I'm trying to get at is what is the value of the loans that we would need to repay to be in receipt of the 265 million premium. And you've sort of started the ball rolling by saying there's 100 million loan that would deliver 50 million of premium. So is it going to be 400 million of loans to get to the 265? Is it going to be 500 million of loans to be repaid to get to the 265? Is it going to be 600? I'm just trying to get to that number. What is it?
No, but what I'm saying is if we repaid all our loans, we'd probably get about a third of the 265 back, because obviously that premium covers all the council's loan book, and borrowing is not just for loans. Borrowing's been for the, there's about the best part of 400 million for the capital programme. We've got about 750 million for property. So our borrowing is not just for the loan portfolio. I would say, if we cashed in the whole of the loan portfolio, we'd probably get about a third of the premium back.
Yeah, maybe I take it up separately because I don't follow the answer, because if 100 million of repaying, if one loan can be repaid for 100 million and that generates 50 million of premium, what's the next best loan to repay and how much will that generate?
Yeah,
and at what point do you get to,
Councillor Critley, just interrupt you. I think Linton wants to comment. Perhaps with that.
So I think your next way of asking it, Danny, might answer. I think I understood what you wanted rather than I think what Danny was answering. In theory, we'd have to repay all 1.8 billion of current PWLD debt in order to generate that
the
premium.
exact 265?
Yeah. But you're right, within that there are some that are different rates and some that carry different levels of premium. So if we picked off the top ones, we might be able to get a bigger level of premium by just paying off some of some of those higher paying loans. The reason why those carry higher premium though is because those are loans on our book that carry the lowest level of interest rate.
Yeah.
So we'd also need to take account of what that would do then to our average interest rate going forward, which would increase. I guess offsetting that, we also need to look at which assets it was and the income that those assets are generating. And it's not all PWLB debt within our portfolio either, so again, we couldn't repay the whole thing. It would be that. And alongside that, the other point is that although we would get back a premium, we would only be able to account for that premium spread over
10 years.
at least 10 years. Actually, it would be slightly less if any of the loans had less time to run than 10 years. We could accrue for that over the length of the loan. But having said that, those that were much shorter dated loans carry much lower premium anyway. So we can probably break it down in a bit more detail for you, but I'm not sure immediately. I don't know if that's answered your question or whether it needs a bit more detail to tell you exactly which loans. But I think if we provided you with a list of what the loans were and the premium against them,
that'd be
you
great.
could almost sort it into order of size of premium and work out which would give you the best return. But of course, you're then left with the risk of what does your overall loan portfolio profile look like after you've done that. And that could cause us other risks in terms of having to refinance parts of it going forward.
It would be great to have that schedule. It would be good to share it with the Audit and Corporate Governance Committee, just so everyone has an appreciation of what could be achieved potentially.
One more, Councillor Critley.
Yeah.
I think it is shared, but I think with the caveat of maybe what Vincent's just described as well, so how that would affect the overall loan portfolio and the risks that produces through doing whatever option we may choose in the future.
Yeah, I think when it comes to sharing this sort of information, we have to be very, very careful that we share a very comprehensive picture that the people who are not as well versed in accounts can understand, and that they do understand the seriousness of perhaps a knee-jerk reaction to disposing of something that then causes other problems, and that sometimes is really, really hard to explain to ordinary people who don't deal in these kind of numbers and this kind of complexity all the time. So we would have to be very sensitive how we did that. I agree that it is interesting and would be helpful, but I don't want it to become unhelpful and something that people would unnecessarily worry about. That would cause.
I don't think it's as straightforward as well. This equation about what's paid back and what it's not just matching things up. I mentioned the £100 million loan. Well, logic would be, well, that's going to generate you 50 million. We'll do that straight away. But if we did that, that's going to affect the whole risk profile of the council going forward. So that might be the best option for the council, because we're not in an ideal envelope in terms of budget and everything at the moment. But is that the best long-term solution? It might be best taking one of the ones where that pays back £1 million, something. So it's a very, very difficult balancing act. It's not just cherry picking, because we could come under challenged by the auditor in the future. Well, why have you chosen that loan when this one's got a better discount factor?
I would like to say, obviously, you were acted prudently in borrowing long against long-term investments, and I just can't fathom why anyone would borrow short-term against a long-term investment. So, we're in terms of those premiums, it's a good discussion to have.
I think what we need the challenge. I've just said to Linton, I think what we need to do, I think to answer your question on the PWLB table, we'll put the premium on in future, so you've got the premium per loan.
One thing I'd add to that though is that obviously you're aware, but that premium does change quite quickly depending on where gilts are going. So it's a discussion we've been having the last few months. I think when interest rates started going up. But when the interest rates changed and the gilts moved immediately after Liz Truss's budget, there was we were talking potentially of a 400 million premium within the week. It quickly came back down again, and it's something we're keeping an eye on. But if we took the whole 250 million premium now by repaying all of our PWLB debt, we would have to spread that 250 million over 10 years, which would give us a return of £25 million a year. That would be to replace the 23 million or thereabouts that we've currently got from our commercial strategy, but would only last for 10 years. At the point of 10 years, it is then gone. So it does require that wider discussion and understanding of what the longer term impact is.
The other one we've got, it may be in the report, as I say, I wrote this a few weeks ago, but we have got, we've been approached by Barclays, so they've offered us a £14.5 million premium on there. With bank loans, the bank's got to offer you the premium with the PWLB, it's linked to a formula, so they've offered us a £14.5 million premium on their loans, and that's more generous than the PWLB premium, so these premiums seem to be growing by the day.
And finally, just one final question, Chair. Can we have an update regarding the status of the DULUC review? And is it possible to share the letter from the Minister with the Audit and Corporate Governance Committee?
No. I can give you an update. It's not possible to share. The actual letter that I have seen a copy of, we were told quite clearly we were not allowed to share that. The update I can give to the committee is that we are expecting very shortly a final report. I've got a meeting next week with DLUC for them to then explain what the process is and how that can then be shared and where it can be shared. But at the moment, that letter and that report only went to the leader and deputy leader of the council, to myself, the chief executive, and to Danny and Claire, and I believe it was shared with the 2 local MPs, but everyone was told not to share it wider than that.
Okay. And there's no member of this committee who has a copy of that report, of that letter?
I believe I might have shared it with the chair, actually, given the role of the chair and the discussion we had with DLUC when the letter was about to be sent to us.
Chair, is it possible to share your letter with this committee?
No.
That's a wait like the rest of us.
Chair, I'll brief. Back to page 74, because I'm not sure it's supposed to balance, but the Johnny Johnson Housing Association, the movement looks like 3.5 million rather than 2.5 million. But it's in the middle of the staples, so I can't work out what the
Yeah. And so we're going to wait to check this. It's just formula error on it should be 2.5 million. I think the figure in the middle, and sorry, my machine's gone again. Should be 12.5. So it was just an error on our formula, carrying something forward.
Sorry.
Yeah, thank you. Yeah, just two simple points of clarification, if I may. 2.10. Can you just remind us what the Warrington Sports holding consists of, the 1.3 million? And the second question is on 4.3, when it says the borrowing portfolio, the rest of the world. I just wondered, it's not the rest of the universe, just the rest of the world. I just wondered what that consists of.
Just on the Warrington Sports Holding. On the Warrington Sports Holding, that's the council's shares in Warrington Wolves. The council was given some shares as part of the, well, my understanding is, I don't think there's anybody here who's been at the council long, and maybe Councillor Marks might remember. As part of the Wolves moving to their new stadium, the council was given some shares as part of that deal, and those shares are held by the council. Although we carry them at a value in our accounts, they're not really worth anything. We would have to find a private investor who wanted to buy them from the council, and it would need the agreement of the rest of the board for the council to sell them to that private investor. I think there was a point about 7 or 8 years ago, we approached the club to ask whether any of the other shareholders wanted to buy our shares. And they were all very interested in buying them, but not at the value that we were carrying them in our accounts. So really they're just almost a fake figure that they're just carrying there just because it recognises that we have been given some shares in the past.
Yeah, just on that, yes, I remember 7 or 8 years ago this came up. But I understand what you're saying about being a fake figure. It just seems, is it going to be there forevermore, maybe? I mean, it just seems a slightly unusual thing to have a figure there which is meaningless. Yeah. I don't know what you do about it.
I can actually comment because the organisation no longer exists. A number of years ago, we were carrying them at the value they were given to us, which I think was £100,000, and that was sitting in the accounts. And the Audit Commission insisted that we had them valued. So we had to spend £20,000 having the 100,000 valued, and the valuation we were told to take at that time, because it was a 9 or 11% shareholding, was that year's accounts for Warrington Wolves. So they went in at a value of what the Wolves' own balance sheet was at that point. But they can't be sold. So it now carries at that point. But what I'm not prepared to do is keep going and getting a valuation statement and paying for that. So in the end, I think we've agreed that we will just carry them at that figure. It is a nonsense figure.
Okay, right, thank you. And the second.
Yeah, it's not the Eurovision Song Contest and the rest of the world. Yeah, it's probably not the best term. I think what it refers to is borrowing that we've got with foreign banks really, and foreign denominated money market funds.
It's not Icelandic Bank, is it?
No, it's not Icelandic Bank. No. We'll change it to foreign banks or something going forward. Yeah.
Okay, thank you.
So, the
recommendation is that the assurance provided by the board is considered by the committee and noted. So we have considered it and we have noted it, and we will move on. Thank you very much, guys.